Hello and welcome to our third lesson. In our previous lesson, we looked at short-term sources of company finance. In this lesson, we will look at long-term sources of finance. We had defined the term long-term finances in our previous lesson, and I hope you understood the term. Therefore, in this lesson, we will look at examples of long-term finances. Examples include equity finance, which is the largest source of finance to any limited company and usually forms the base on which other finances are raised. Equity is the total sum of the company's ordinary share capital plus the company's retained earnings. Equity finance is made up of various finances, and we will start by looking at ordinary share capital. Ordinary share capital is the finance contributed by real owners of the company. This finance is only raised by limited companies. It's permanent finance to the company and can only be refunded in the event of liquidation. For example, in Kenya, a company cannot buy back its own shares. Ordinary shareholders have their rights, which include 1. They have a right to vote. 2. They have a right to inspect corporate books. 3. They have a right to sell their shares to other parties. 4. They have a right to approve the purchase of capital assets. 5. They have a right to appoint directors. 6. They have a right to appoint or remove auditors of the company who will oversee the company's affairs. Features of ordinary share capital includes 1. It is a permanent finance to the company which can be refunded only during liquidation. 2. It is the largest source of finance to the limited company. 3. This finance has a residual claim on profits and assets during liquidation. 4th, ordinary share capital is entitled to voting powers, each share usually being equal to 1 vote. 5. It's the only finance which will grow with time as a result of retention. To view advantages and disadvantages of ordinary share capital, visit techneragency.site. Another example of equity finance is preference share capital. This is the finance contributed by quasi-owners or preference shareholders. It's also called quasi-equity because it combines features of debt finance and those of equity finance. Therefore, let's go on and look at advantages and disadvantages of preferred stock. The major advantage? By using preferred stock, a firm can fix its financial cost and still avoid the danger or bankruptcy if earnings are too low to meet these fixed charges. The disadvantage of using preferred stock is it has a higher after-tax cost of capital than debt. The major reason for this higher cost is taxes. Preferred dividends are no deductible for tax purpose, whereas interest expense on debt is deductible. Now let's go ahead and look at similarities between ordinary and preference share capital. 1. Both finances earn a return in form of dividends. 2. Both form the company's share capital, share finance. 3. Both finances are not secured. 4. Both finances are raised strictly by limited companies. 5. Both finances are long-term finances to the company. After looking at equity finance, let's now look at another source of long-term source of finance, which is debt finance. Similarly, debt refers to loans taken from creditors, from banks, and more. Examples of debt financing include bonds, business loans, trade credit, credit lines, and extra. Visit our website, techneragency.site, to read more notes on examples of debt financing. On this slide, we look at classification of debt finance. Debt finance is classified into A. Short-term finance, which ranges from 1 month up to 4 years and is given to customers known to the bank or to lenders. B. Medium-term finance, which means this finance will be in the business for a period ranging between 4 to 7 years. Lastly, long-term finance, which is a rare finance and is only raised by financially strong companies. It will be in the business for a period of 7 years and above. Let's finalize our lesson by looking at other forms of debt finance, which debenture finance. Debenture finance is a document that is evidence of a debt which is long-term in nature and confirms that the company has borrowed a specific sum of money from the bearer or person named in the debenture certificate. Classification of debentures: A. Classification according to security. For example, secured and unsecured debentures. B. Classified according to redemption, for example, redeemable and irredeemable debentures. C. Classified according to convertibility. For example, convertible and non-convertible debentures. D. Subordinate debentures, naked. These are issued with a maturity period of 10 years and above, and usually they carry no security and depend upon the goodwill of the company. We have come to the end of our third lesson. I hope you gained financial knowledge and skills. Bye for now. Let's meet in our next lesson.